what your advantages and disadvantages are before you make a decision to buy a home or sell your home. What your advantages and disadvantages are before you make a decision to buy a home or sell your home. All right, let's get started. Everybody, this is Renee Daggett, and you're an EA. What does that mean?
Yes, those initials stand for enrolled agent, and an EA is not as well known as a CPA. Everybody has heard of a CPA, but an enrolled agent is similar to a CPA, where we have to take specific tests in order to get our certification.
Right.
An enrolled agent is federally regulated. We are regulated by the IRS, where a CPA is regulated in the state that they live. Both of us have to do continuing education, background checks, but those are similarities. I can represent my clients before the IRS just like CPAs. EAs usually will specialize in tax because 95% of the tests that we take are in taxes, where a CPA may specialize in tax, but a lot of them will go into audits or, those kind of things. The test that they take is in debits and credits and accounting and a little bit of tax. We do a little bit of accounting and a lot of tax in our certification. So that's the difference between enrolled agent and CPA.
And if I got in trouble with the IRS, could I call you?
Absolutely. I've represented clients before the IRS in a paper audit and an actual audit. I've been downtown San Jose in their building to talk to the people down there. So we can do the same thing that the CPAs can do. We just can't go into IRS court, but we can represent our clients in an audit.
Because IRS court isn't a federal court, it's a state-run court. Is that correct?
I'm not sure if I would deem it that way. You have to be an attorney to represent clients in court. And I am not a tax attorney. That's another certification or an exam that you have to go through. And that's not me.
And that's like the big thing, right? Because, if you're working at a restaurant or a retail outlet, there's not a lot you can do to get deductions, especially if you're a renter, right? You're just paying the taxes, but you're also not making a ton of money. Once you get into a career track, say you're a professional engineer, software developer, marketing, what have you, and you start making a little bit of money, then you need to figure out how to get those write-offs. And buying a house is one of the best vehicles to do that, right? And Renee was mentioning before you showed up, because you like to show up late.
They say it's fashionable, Renee.
It's an Air Force thing.
I'm not sure how we put this in the recording, right?
Yeah. That's the only thing Vito has to work on is he was a Marine, I was in the Air Force, but that's okay.
I am a Marine. What's a Marine?
Always a Marine. Yes. Yeah, that is one of the big questions, Renee, that we hear, a lot, and it's people have this preconceived mindset. And let me back up just a second and say, I think it comes from when folks are thinking about buying a house, they go to the people they love and they trust, and that's their family and their friends and somebody else who's bought a house, and everybody has an opinion. And so they get these opinions, but they may not be fact-based, they're emotion-based. And so people will go, and this is a question for you, but people will come to me and say, well, yeah, but Dan, there's no way I can afford to buy a house. My mortgage is $1,200 a month, and it's going to cost me $2,000 a month, because that's what my neighbor's mortgage is. And how do I do that? I can't do that. They don't understand the net at the end of the year with the write-offs they get by being a homeowner. And so can you maybe expound on that a little bit? So for those, folks we're working with who may be thinking that, to help them understand, no, wait a minute. Now, there is a way that you might be able to, at the end of the year, net, have been able to afford that, whatever that number is.
One of the scenarios is, you're paying $2,500 in rent, but then everything put together in purchasing a new home might be $3,500. At that point, it may not make sense budget-wise to buy a home. Vito and I were talking about building your career and, making $300,000, $400,000 a year and really increasing your income there. But for me, the conversation becomes very valuable is if you're paying rent for $3,500 in Sunnyvale and you definitely can afford the $3,500 rent, if you can get a house and pay $3,500 for buying a new house, that's where it makes sense budget wise. And there's two things that I would recommend that you do is you go through a budget, and you guys have some great tools and great conversations in working with your clients on that, but just having them create and go work through a budget of everything that they need to think through, not only the reoccurring amounts that they need to pay out that are deductible, like mortgage interest, property tax, but all the other things that are not deductible, like maybe HOA dues or homeowners insurance or repairs, right? You kind of have to budget a little bit for that. But if it makes sense that they have the cash flow to go from being a renter to being a homeowner, it just makes sense. The thing is that you want to be aware of is if you're taking that $3,500 of rent payment, converting it to partial deductible payments for mortgage interest, property tax, what does that look like on the tax return? That's when we sit down in like a Zoom call like here, where we put in year-to-date numbers, project taxes through the end of the year, and make assumptions of paying a mortgage interest and property tax. And what does that look like? Now, it could give them $2,000 more of a refund than they had by just renting, or it could be a little bit more. It just depends on the mortgage interest amount, the property tax that they're paying. So for me, it's all about making sure there's no surprises, thinking I'm going to get back $20,000 because I'm paying $20,000 in mortgage interest. It's not a dollar for dollar deduction. It's a reduction of your taxable income.
If you make $100,000 a year and your writable deductions are 25, then you report $75,000 as income and you pay income tax on that $75,000.
Correct.
Good boy, Vito.
You passed the class.
See, even crayon eaters know how to do math.
Yeah.
All right. So when you go to the deductions, you can write off every year your mortgage interest, correct?
Yes.
And then your property tax.
Yes, fully.
And we were kind of talking about that before Dan so eloquently decided to show up.
Oh, this is going to be a tough video.
Yes, it is.
Yeah.
With all the ad valorem taxes, when you go in, you say, hey, Joe, you bought this house for $1 million. Your assessed value is $1 million. I can write off 0.79% of that, which is $7,900, right? Whatever the exact figures you come up with. In Santa Clara County, we have ad valorem taxes, we have Melrose taxes, we pay garbage bills through the taxes. There's a lot of other things that help go pay for the schools and the roads and the police, the sheriff department and all that kind of stuff as well. Those ad valorem taxes we cannot write off. Is that correct?
Oh, you're asking a question.
I am asking, yes.
So I want to be vulnerable and say, I don't know if those are included. What we do is we go online and look at the unsecured property tax bill, look up your parcel number, look at your address, and what you paid on there is deductible. So I don't know how they show those other taxes, but that's what we grab along with the mortgage interest statement. Sometimes you pay your property tax like in an escrow account. So it will say the property tax total there. We grab that total on the 1098 tax form, plug it into the tax return, and that is what is deductible. So if all those taxes, Vito, are in that lump sum, then yes, it is deductible.
Okay. And then mortgage insurance, is that deductible?
For now, mortgage insurance is deductible for the 2020 year. That has expired going forward. And there are some limitations for mortgage insurance, meaning if you make too much money, they're not going to allow you to deduct mortgage insurance. But for the 2020 year, mortgage insurance premiums are deductible.
Got it. Got it. And then HOAs, I heard you mention that HOAs are not deductible.
Yeah, people get that confused. They think, okay, homeowners association and homeowners insurance,
Mm-hmm.
so those two items are not deductible on your tax return.
Right. So if I were to buy a condo or a townhouse and I had to pay $300 a month for the HOA and then another $200 a month for the mortgage, my homeowner's insurance, I get to write off the $200 a month, not the HOA. Correct.
In 2020, not in 2021, which we're going into here. So, yeah, that's
smoke and mirrors. It's all smoke and mirrors. You always wind up paying about the same anyway. Just depends on how you eat it.
Rules change all the time. So, in fact, the Senate's getting ready to put out a bill regarding PPP, and it's probably going to come before the end of the year. So, rules change all the time.
So Renee, I have a question for you, and this gets asked again quite frequently. I'm doing repairs to my home, just maintenance kinds of things that have to be done. And that repair then leads to, let's go ahead and upgrade our kitchen, or let's upgrade our bathroom. And then all of a sudden, honey, we got a leak in the roof. And so, oh my gosh, I've got to bite the bullet and get that roof done. So the difference between repair my fence, put new granite in my kitchen, repair my roof, all of those, what is tax deductible, and can it be taxed? Can that deduction be taken in the calendar year? And the other question, Renee, part B of that is, I've heard that some of those deductions that are not allowable during the course of you being the owner of the home, when you sell your home to reduce maybe your capital gain exposure, certain deductions can be made. Can you help us with that?
Absolutely. It's something that can be very confusing. The IRS has strict rules on what home improvements are. And let's talk about and give some examples of home improvements. So if I paint my walls, that's not improving my home because I'm painting my walls. It's a repair, it's a maintenance kind of thing. That's not deductible. But if I want to replace the floor in my living room, and I'm going to make a very obvious example. If I have laminate in my bathroom and I replace it with laminate, that's like kind, replacing the like kind. But if I have laminate in my bathroom and I want to upgrade it, improve it with tile, then I can deduct that because it is an improvement. So if you repair your roof, you're just maintaining your home. But if you replace your roof or build another bedroom on the back of your home, or build a swimming pool, or anything like that, that's an improvement, you're going to want to keep track of that. And I would say the best way to keep track of those improvements is just to have a file folder in like a home office and throw the receipts in there, because after you've lived in the house for 2-3 decades, it's going to be difficult to kind of recreate all of those improvements that you've taken. Now, as far as deductibility, getting to, I think that's your part B of the question, you cannot deduct these improvements in the year that they are upgraded. What happens is when you sell your home, all of these improvements that you make will reduce the amount of the gain of your selling your home, and you pay taxes on the gain, depending if you meet the exclusion or not. And that might be a great next question.
What is the exclusion? Yes, that is a great question. What is that exclusion?
So when you sell your primary home, how you calculate the gain, let me see if I can explain this in English. Let's just say that you sold the house for $1 million and you bought the house for $800,000. No tax is going to be due because the IRS gives you an exemption of $250,000 per person. So if you're married, the exclusion rate is $500,000.
Okay.
So if we take a similar example, you sold your house for $1 million and you had $200,000 worth of improvements over a decade, your gain would be $800,000. And so taking that exclusion of a married couple of $500,000, then your gain is now $300,000 that you would pay taxes on. And the good news is that that $300,000 is not going to be taxed at the income tax rate. It's going to be taxed at a capital gains rate, which is different. And I would say most people will pay about 15% capital gains rate. There's a 20% capital gains rate, but that's when your income is higher, like high 400,000s over 500,000. But most people will pay about 15% on that gain.
So furthering that question, what happens if I'm 75 years old and retired and I sell that? What would my capital gains tax be? I mean, considering the fact I'm taking in Social Security and what have you. If I don't take an income that year outside of my Social Security, and let's say that that's $25,000, because that's all Social Security is going to give us, am I going to see a capital gains tax rate?
So if you're under the exclusion, you report it on your tax return and there's no capital gains there. You just report it and there's nothing to pay. Now, if you have Social Security that you're getting paid and that's all the money you're getting as a 75-year-old man in this example, there's no taxes because you're not taxed on that Social Security. But when your income goes at a certain threshold, then you're taxed up to 85% of your Social Security. So depending on your scenario, we'd have to plug in the numbers and verify what that looks like for each.
I'm going to use a little different scenario though.
Okay.
Married couple has $500,000 exclusion. Sell their house for $1 million. They paid $600,000 for it. For getting any, so there's a $400,000 gain. So repairs, improvements doesn't matter. They're under the $500,000. They have no capital gain exposure.
Correct.
Same married couple sell their house for $1 million. They purchased it for $300,000.
Mm-hmm.
So now they have $700,000 gain.
Mm-hmm.
Minus $500,000 is $200,000 exposure. Minus anything they can show that was improvements, $100,000. Net $100,000, they're going to be taxed at whatever the capital gain tax rate is.
Correct.
Oh, buddy. Did I nail that?
You got it.
Huh?
Okay. You forgot selling costs.
Well, yeah. Well, okay. Well, minus the selling cost.
Okay.
Okay, but the concept, I've got the concept.
Yeah.
Concept is correct. Spot on.
Are appliances deductible when you go to sell? If you replace a fridge?
Right. If you keep a refrigerator in there, like a built-in fridge and stove, you can deduct those. Anything that's improving your home, you can deduct when you sell your home.
Okay. And now if I did it myself, let's say that I put in a paver system in the backyard and I kept the receipt for the pavers and I did all the work myself. Can I write off the tax? Can I write off the cost of the bricks?
You write off the cost of the bricks only. You cannot write off your labor.
Even if I charge myself.
Yeah, because one of you would charge $50 an hour, the other one would charge $100 an hour, and the IRS just doesn't allow for that.
Yeah.
Are those improvements going to help you from a personal income tax writing off? perspective when you file your income tax for that year end that you sold the house?
If you're under the exemption and you pay no capital gains, the improvements will not help you on a tax point of view. Obviously, it improves the value of your home and you can sell it for a higher amount.
Right. Okay.
Mm-hmm.
So having the receipts and having an accurate record of any improvements you've made from the time you bought the home until the time you sold the home is only a consideration if you are going to exceed your capital gain gift, or whatever you want to call that.
Deduction. Yeah, exactly. So it's a moot point if you see yourself in the house 5 years, you're not going to exceed it. But there are many people that bought their houses in the 70s and 80s, and maybe they're thinking of moving out of California or downgrading. Maybe they're older and they have a 2-story. So they want to sell their home. And a lot of times they've been in their home for decades. And to recreate that, the IRS allows you to recreate that. And it has to be, reasonable. And maybe there's, several remodels done on a bathroom. That could be when you're in the house 40 years. It's just important to keep those receipts. And like I mentioned, the best thing to do is just to have a file folder to throw the paver receipt in there, because it has the date and how much you paid for it. So you can recreate that list.
If you have a client who's in that situation and they didn't or don't have all of those receipts, but they could certainly go back to the people who did the upgrades, or where they bought the refrigerator or the countertops.
So what we do in practical terms in that situation, Dan, is we tell the client to list all the improvements that they remember and to put an approximate dollar amount next to the roof, the bathroom, the countertop. And then, adding everything up in Excel, and we will then put that on the tax return to show as an improvement, the lump sum. Now, if the IRS comes back and questions them on that, they have every right to ask for a receipt. And if you can't produce the receipt, they may not allow that improvement deduction. But what I tell people is, if you did that, it's an honest answer. It was from 30 years ago, you don't have the receipt, or even 5 years ago, you don't have the receipt. It needs to be reasonable. If you just are on your honor system, you put it on there. For me, I don't have a problem in putting it on there. The problem that I have is when clients pad that number and it's not reasonable, whether it's solar or a roof, and, they're putting crazy numbers on there for those improvements. I cannot argue, to the IRS for that when there's no receipt and it's just not reasonable.
Sure.
What's your point of view on solar leases versus buying solar outright?
My personal opinion is, if you can buy solar, buy solar. Do not lease.
And the reason why, if you're watching this, the reason why is, one, when you lease it, it doesn't belong to you. It's an attachment or a lien on the property. It doesn't hinder the value of the property. But when you go to sell your house, the buyer actually has to go back to that lease company and say, hey, I'm buying this house. I need to qualify for this lease. And it'll affect your debt to income ratio, which we talked about in earlier videos. If you're buying solar and you're putting it on the house, it's an actual improvement. You get to write that off when you go to sell it, and you get the enjoyment of that. You get tax benefits and tax credit that year, sometimes depending on the state and federal, mood. So just so you know.
Hey guys, I know we're coming to the end of our time, but I wanted to bring up a question that we've been getting with the shelter in place and COVID season that we're in. Many people have been forced to work from home. And I wanted just to talk about for a moment on the home office expenses that are incurred there. So if you're an employee that had to work from home because of shelter in place, and you're still working from home, or you worked from home for a temporary time point of view, I just wanted to let you guys know that years ago, we used to be able to deduct home office expenses on our tax return, but those deductions are suspended through the year of 2025. I wanted also to let you know that there is another option. There is an IRS code section 139, where back in 2008, President Bush deemed the country in a disaster situation. And with COVID, we are in a disaster situation with what we're dealing with COVID-19. And this section 139 allows business owners to pay for home office items that are needed for their employees and give that to them as a stipend to pay for a desk, a printer, webcam, whatever that they need from the home office. Now, the great thing is it's a tax deduction for the business owner, but it is tax-free to the employee for any home office expenses. So if you're somebody that is working from home and spent money on some home office items that are needed in order to do the job, check with your employer and let them know about Section 139. The other thing is, if you have a small business, the home office deduction is a fantastic reduction of self-employment taxes if you file a Schedule C small business sole proprietorship tax return. And so this allows you to deduct mortgage interest, property tax, utilities like PG&E and garbage, and it goes against your self-employment tax, which is 15.3%. And it's a great tax savings if you have a small business. But I just wanted to circle back to, if you're an employee, that Section 139, not many people know about it. Get educated on it. Talk to your tax professional about the benefits of it, because it's important to be educated on what you can do.
Yeah, and that's a great point, because I know a lot of people that work for companies as a W-2 earner. You're getting a paycheck. If you're a 1099, you get to write off a lot more expenses. And right now is the time to start a side hustle. And I have a side hustle. I know you've done a lot of different things, but I have a side hustle. My wife has a side hustle. And we have these little side businesses that produce a little bit of income that we can use to as a write-off to further help our tax write-offs. And they're true, legitimate businesses. It's not like I'm a bonsai guy and I have this one plant and I call this a business. It's a true business, right? And if you're struggling and you're a W-2 earner and you're making a couple $100,000 a year, start a side business. Go into Amazon, start selling camera equipment or what have you. That's a side business. It's a legitimate business, and you can use that to deduct what you were just talking about, right?
Absolutely.
So I know we're right there, right? Renee, it was awesome talking to you today. I appreciate this whole hour that we got to spend together. About 35 minutes with Dan.
He's going to harass you.
I'm gonna hear. Unfortunately, we're together the rest of the day, and I know this isn't the last time you hear of it. I started the day off by telling him I'd buy him lunch today, thinking that would ease things, but it hasn't.
Nope. That's okay. So I appreciate all your time. I hope if anybody wants to get a hold of you, I have your contact information down below. I'll have your contact information available to people to download and give you a call and ask you any kind of questions, right?
Absolutely. Glad to speak with anybody if they have questions, especially in buying the home.
That's perfect. I appreciate it. And I'm sure we'll be in touch for the next time we have some tax questions. And that's it for now, guys.
Thanks so much, Renee. Merry Christmas to you and your family.
Merry Christmas.
Merry Christmas, guys.
Okay. Thanks.
Right.
Bye-bye.
Bye for now.
Bye.